Good morning, Australian expats. My name is Jeremy Harper. Joined in the seat is James Ridley, Managing Director of the APAC of Atlas Wealth Group. Morning, James. How are we going?
Good morning, mate. Going well, going well. There's a lot to digest since our last episode. I just feel like the media circus just continues on CPI, legislation changes, SMSF changes, residential property. It's all happening. So I thought, what a good day, you and I, just to unpack the recent updates only in the last week, remarkably.
Yep. Yep. We should be doing a monthly sort of recap now. It's changing quite frequently.
It certainly is. And today we wanted to deep dive a little bit into the CPI print that came out for the month of May. That's important. Want to talk about SMSF and the change that they're making in what's called the limited recourse borrowing arrangement that you can have within superannuation, self-managed superannuation, I should say. Lastly, the CGT. There's been some updates to that as well regarding divorce and death events, and just how it applies obviously to expats. And then lastly, just a bit of Q&A to wrap up for today's episode.
Yep. All right, let's get stuck into it. So we had the May CPI print that came out this week. What were your thoughts on that?
I was actually expecting it to be higher, to be honest, just because from the flow-on effects and the sort of snowball effect from the Middle East, I was actually expecting us to climb up and be above 5%, just because I'm expecting June quarter to be almost 6%. But the way it's tracking, I'm actually quite surprised. I think it rose up to 3.6%. Headline annual was 4 from 4.2. Um, remarkably, like we're not jumping up from a dramatic CPI inflationary point of view, which is actually really good to see because it means the RBA is likely to probably hold its current position. If it was jumping up a lot more aggressively, then would probably be a little bit more concerned. Was there anything that stuck out for you?
No, I mean, it is just a monthly print, so we have to be sort of keep things in perspective a little bit. I mean, if
Yeah.
you look at the major readout, which will be for the June quarter, that's going to come at the end of July. So the
Yep.
29th, which will just be in time for the next RBA meeting, which is on the 11th of August. So they'll have that full data readout for the full quarter. But if we look at the rate tracker since that release, it's sort of still hovering around that sort of 70% of a no change in terms of the next meeting. And there's about the market's factored in maybe about a 30% increase by 25 points in the August meeting.
Mm.
But yeah, the market still thinks it's going to be a hold for the August meeting.
Yeah, yeah, I think that's pretty sensible. It just hasn't jumped up as aggressively as I thought it would, to be honest. We'll see what happens over in the Middle East. See if things calm down a little bit. We were in peace talks, but it seems like that's again been sidestep, put on pause again. But we really just need the Strait to reopen and let the oil flow at the moment to just cure the inflationary effect. But we'll wait and see. But no, nothing dramatic in that monthly print. I think a lot of expectations there. Again, I thought it'd be a lot more. Let's change gears a little bit and talk about probably actually wanted to talk recently about the currency movements on the FX rate. I don't know if you've kept an eye on that, where the Australian dollar's weakened a little bit because the US dollar's strengthened. We saw 69 cents again. Does that have much of an impact on serviceability or anything like that for Australian expats?
It'll work in their favor if the Aussie dollar's weakening against the USD because
Yep.
as most expats know, a lot of the currencies are more or less pegged to the USD. So
Yep.
a stronger USD means that our borrowing capacity will increase.
Yep.
Relatively speaking, if you've got a lot of overseas outgoings, your rent and mortgages and things like that, that will end up factoring at a higher rate as well. So that will work against you, but more or less your income will reflect a stronger borrowing position when we try
Mm.
and get lending on the Australian side.
Yep. Yeah, okay, that makes sense. So, I mean, definitely beneficial when the AUD is weaker for Aussie expat lending. Um, I think it's dropped a little bit based on expectations that there might be a rate increase on the US side. So that strengthens the US dollar naturally. But if that doesn't happen and we get another rate increase on the Australian side, then you'll see it probably go back up to maybe 72, 73 cents where it was heading previously before that sort of data that came out of the US. Let's change gears a little bit and talk about self-managed super funds and the recent update as part of the budget and running it through the Senate at the moment.
Yeah, this really came out of nowhere.
Yeah.
It wasn't in the budget at all. It
No.
was sort of something that was really snuck in between the Labor government and the Greens.
Yep.
And I'm not entirely sure why the Greens pushed it. I actually, my personal opinion is I think they're just sort of like political cover for Labor. I think they probably wanted this included because I think a lot of this goes back to the Labor wanting people to put money in their union super funds.
Yep.
And, self-managed super funds is a direct competition to that. So I
Yep.
think by putting this through, it's not going to do anything around housing affordability. They even came out and said that sort of under 1% of all home loans are in limited recourse borrowing arrangements. And I guess maybe we'll
Mm.
unpack what that is. So, for Australians, you've got the option to set up your own self-managed super fund. There's a lot of flexibility with that arrangement. A lot of Australians are doing that. You can have up to 6 members. So you can
Mm.
have mum, dad, you can have kids in there. You can all contribute your super into there. And it gives you a bit more flexibility around what you do with your own retirement funds, right? So
Yep.
you can invest
Yep.
in property, you can invest in direct, gold, things like that. You can even buy artwork. But specifically about the property piece, up until now, you had the ability to leverage that and go in there
Mm.
and take out a self-made super fund, which is limited recourse borrowing arrangement where you'll have a bare trust in place and
Mm.
that trust and the self-made super fund will be responsible for that loan. Obviously, you'll still have to guarantee it, but it sits within that entity and allows people to access funding to go ahead and get, an 80% loan and go and buy
Yeah.
residential investment property.
Yep.
My point of view for a lot of people that have funds there, it's quite a low risk way of taking your super contributions, particularly if you've got, say, 10, 15 years of working age,
Mm.
contribute that towards the loan plus the rental income. And quite often people will pay the loan down. They'll have a property there at retirement that may have a small loan or completely ungeared, but that's
Yep.
been completely stopped. So
Yep.
in terms of lending within the self-managed super fund environment, it looks like only commercial property is still available. That was
Mm.
untouched. But in terms of what they've put through is that essentially they're trying to get royal assent to say this will be grandfathered in. So if you've got existing properties, that will be untouched.
Yep.
But you've got 45 days to execute on your contract. Anything after that date, which just sort of takes us through to the end of August, no longer be able to access it. My point of view, there'll be two knock-on effects already I can see. We
Mm.
always
Mm.
talk about this. There's always these unintended consequences. One is, for people who've got existing arrangements, borrowing arrangements, fine, but you'll probably see a lot of the banks start to pull back that are offering this because it just won't
Yeah.
be worthwhile. So it will
No.
create a market where when the big banks pulled out of self-managed super fund lending,
Yep.
the existing back book, they just jacked those rates. So people that were, with St. George or Westpac who had a self-managed super fund loan, they're probably paying 8, 9% on that loan because
Wow.
the bank's like, well, we're no longer servicing this client. We'll
Yep.
just charge them
Make
more
it.
and they can figure
Make
it out.
make what
I
we can
th-
out of them.
yeah, I think that's going to happen now for existing borrowers out there because
Mm.
I don't think there'll be much of a refinance market because it probably doesn't make sense to offer that product. There's just
Mm.
no volume. So that's something just to be mindful of. And then secondly, what does that do around the commercial space? Does that make that more expensive, that type of borrowing in the self-managed super fund space as they're trying to claw back margin, those lenders? Because quite often the
Yeah.
lenders would offer both resi and commercial, but if they're only going to offer commercial going forward, what does that do to the product?
Yeah, geez, it's such a tough one. I mean, there's obviously, I know there'd be a lot of investors that have SMSFs that would be going, shit, I need to try and buy a property in the next 2 months before it receives, or next one and a bit month before it receives royal assent, and it gets through actually the Senate. But um, there's, when you think about how many SMSFs there are, which are thousands, it's making up a less than 1% of home loans. Like, so what's this really achieving, to be
Yeah.
honest? This isn't really going to move the needle on the Australian residential property market at all. It's just a nice to do for the Greens to get them to sign off. I don't know whether this will hold true and stay in. It might stay for the next, say, 10 years until we have a new government that winds it all back. But yeah, very real concern there. Obviously, industrial property, commercial property, so that's like office spaces, sheds, warehouses, all those sort of things. They're untouched under the commercial banner, but just residential. But now they've really just moved and tipped the scales that now investors that have SMSFs or wanting to set up an SMSF, well, they won't go into a residential property. They'll focus on commercial property now. So if anything, they've just given a boost to commercial property as an asset class, to be honest. So definitely make it more competitive. I can see yields being jacked up as well, much like what's going to happen on the negative gearing side within outside of super. But I was surprised that it was just an amendment and it didn't have to go back and revisit the lower house. Amendments can be made through the Senate, and then even if it's new legislation and then still passed and roll through. So it's a bit interesting that. I really thought it'd have to go back through the lower house, even though that wouldn't really slow it down, to be honest, because of Labor's numbers. But yeah, I think when you think about an SMSF, it's really hard for Aussie expat who's a non-resident of Australia to run an SMSF. There needs to be some other members there and not breaching the active members test. So just buyer beware. If you're setting up an SMSF and you're a non-resident and you're your only member, that's really difficult to do. But SMSFs, a lot of people have them. You shouldn't have them if you've got a really small balance, to be honest. I think when crypto was all the rage, a lot of people went and turns their $20,000 or $30,000 super funds into SMSFs and bought crypto when they forget that they've got to do an annual tax return for probably 2 or 3 grand. So yeah, it's going to be interesting to see how that one rolls through and the impact that's going to have over the coming years. Would you say there's a bit of a checklist there in terms of anyone that has an SMSF and what to consider?
Yeah, I mean, if you're looking to purchase and if it's an off the plan, just be mindful. This will come down to the contract date. So you want to make sure it's
it will.
completely executed. You want to make sure that the purchaser on that contract is correct. You have to list out the bare trust and all those details. So make sure that's all correct, because you don't want to be amending that contract after this window, because you're going to fall into a lot of issues. And then just really watch this space and making sure that you've got a couple of lenders available in terms of funding. These things will move quickly. One of the bigger mortgage managers gets funding across the line. So if they pull back their funding lines, that's going to impact a number of mortgage managers as well, which will reduce your lending options. So making sure you've got not just option A, but you've got B and C there just in case.
Yeah, absolutely. Absolutely. That's a good one. All right, let's have a look at the next topic of our session today, which is still about the capital gains tax changes rolling through, and then just fleshing out, because it's got more attention, the impact if we are going through a divorce or there's a death. So, and this is essentially extending to those that pass away are the joint owners, or that asset is then moved into the estate and then it's inherited by the heirs. So again, just to reframe the current CGT change. So from 1 July 2027, the 50% CGT discount is being replaced with that cost-based indexation method, plus a 30% minimum tax on net capital gains for individuals, trusts, and partnerships. It doesn't apply to companies, because companies are not eligible for those kind of concessions because they already have a fixed minimum or maximum tax rate on any realized gains. Gains accruing before 1 July 2027, they will keep the 50% CGT discount. Gains after that are then split taxed under the indexation plus 30% minimum floor for tax. So good one. Again, negative gearing, that's also going. It is being grandfathered. So anything that you can negative gear right now that you owned before budget night, that still remains as is. Any new purchases that you're buying right now where it's an existing residential property, you cannot negative gear. You just accumulate the losses in a bit of a bucket on your income tax return, and they can be used to offset taxable capital gains against property in the future as well. And then if you want to get negative gearing against your wage income, then they're encouraging you to buy new builds. So anything that's adding to the housing supply. We had a number of questions on our budget webinar, seems like a year ago now, but it was only a couple of weeks because this is how fast and how much content's coming out from this. But I had questions where people asking, what if I buy I've got an old house that I just, do a renovation on and then I rent it out, but it adds a bedroom or something like that. No, it needs to add to housing supply. So if you've got, say, a parcel of land and you subdivide and you put a dwelling on it or a duplex, great, you're adding to housing supply. So that would actually be covered. If you have an old residential property that you're knocking down and building a unit block on or something, again, great, you're subdividing into many titles and you're adding to housing supply. So that's really important. It'll just be interesting to see what this does to like the off the plan market. I think those that are love flogging off the plan properties are just going to be licking their lips at this and going, this is great. They've just saved my job. It's going to make it a lot easier. And that bill was passed obviously in the House on the 4th of June. So we'll see what happens as it comes out of the wash in the coming days, because they're racing to get it all finalised, ticked off by the 2nd of July, which seems like they will.
Yes, yes. And then I guess, should we talk a little bit about how
new
that would
angle.
impact the death and the divorce? So
Yeah.
death, so as we know, so death's not a CGT event.
No.
So the asset that will pass, you normally take on the original cost base and that acquisition date.
Yep.
And that hasn't been touched. But what will happen is they've got this thing called load bearing. So when the beneficiary who takes possession of the property does go and sell in the future, the gain's split. So at 1 July 2027, you'll get the legacy portion. They'll get that 50% discount. And then anything from that 1 July 2027 date onwards to when it was actually disposed will get the indexation and 30% minimum tax.
Yeah.
That's just something to really be mindful of, that there'll be a split in the tax treatment from that date.
Yeah. Yeah. It's like, it's not new, but it's just something that everyone's sort of now starting to realize the flow and impact of the legislation that's being obviously, that's been written.
Yep.
I think you'll see more of these examples coming out probably over the coming months as people start to run through hypothetical scenarios going, oh, hang on, that means ordinarily this wouldn't be a taxable event, but now it's splitting the event into, a portion being under the 50% CGT discount and the portion being under the new one as well. Same again with main residence exemption. If someone passes away and their main residence then moves into the estate, you're still entitled to that partial main residence exemption and the 2-year rule after they pass away to sell it, and it's a tax exempt transaction. But then after that, it'll then become a taxable capital gain if you're holding it for more than 2 years. And then the new legislation will be applying to that as well, because if that 2 years ends and you don't sell it within the 2 years, then technically be treated as an investment property from the day of death. But if it's obviously happening after 1 July 2027, then you're only ever going to be entitled to a partial main residence exemption up until 1 July. And then going forward, the future capital gain is just going to be based on the cost-based indexation method and the minimum 30% tax as well. So still getting obviously a pro rata there, but it's just being mindful that you'd be splitting the tax, that sort of the tax scenarios there, how it's calculated. What about divorce and relationship breakdown?
Yeah, well, I think this is probably, there's a lot more of this happening. And so
Yeah.
both of these updates will impact expats out there. But so with the breakdown rollover, so as long as it's under a court order or a BFA, you still defer that CGT until when you dispose that asset. So if you had, say, a property in the husband and wife's name and it transfers to one party, there's a rollover at that point. But then when you go to sell later, that's similar treatment. So you just need to be mindful around that. From 1 July 2027, those new tax treatments will apply.
Yeah. Yeah. Okay. So, gosh, it's just, just keeps getting worse. But yeah, again, this is just one of those other sort of hypotheticals where as we get a bit more of an understanding of the new legislation, this is sort of that flow-on effect, the snowball effect. Again, there'll be more of these. I think Senator David Pocock, he came out and said, it's going to be impacting divorcees unfairly, especially women, when it comes to, the property, the CGT, where otherwise it would have been more favourable under the old rules because they wouldn't have to pay tax and as much taxable capital gain because the discount would still exist. So, unfortunately, more of this will come out and keep coming out. Certainly not an averaging in the bill. I guess why does it matter most for people forced to sell because of a life event rather than a tax plan? So it's just, yeah, it's such an interesting one going forward. And I guess critics flag that this real structuring gap at the moment. We've got to remember as well, when they abolished the main residence exemption, there was a carve out for life events
Yeah.
as part of that, but this is really just closing the gap as well. Expats are going to be dramatically impacted by the new legislation, and we'll have Ben on, the managing director of our tax arm, to unpack that once the legislation has been completely finalised. So watch out for that episode because that's going to be a really important one.
Yeah, and I think particularly for the, relationship breakdown event, that is, I see it all the time with these files. It's a liquidity crunch. So quite often they will need to dispose of an asset. And the second, well, one, there'll be a liquidity crunch, so they have to dispose of an asset at some point. And the second part is quite often they're going from, two incomes down to one. So
Mm.
serviceability is not there. So it's really difficult to actually hold on to those properties as well from a
Yep.
serviceability under that one person. So yeah, that's
Yep.
really tricky to plan for that. Really, really tricky.
Yeah, yeah, absolutely. And I think if we wanted to just tie the three themes that we've been talking about today, you've got inflation, you've got the LRBA loan changes in SMSF and the CGT reset. I think it really emphasizes that whenever you're looking to invest, it's so complex. So seek advice,
Mm,
if you're unsure of what you can lend on, get a pre-approval, engage with your mortgage broker or an expat specific broker. If you're unsure of what you should be buying, the purpose of it, the goal, seek financial advice. Right now, the cross-border picture is just becoming more and more complex when we factor in the changes that are rolling through. So yeah, an interesting one at the moment.
definitely, definitely. So I've
Yeah.
got a few questions to round this out. Maybe
Yep.
I'll throw, one of these. I've got this one about self-managed super funds. I think you're across this. So
Mm.
my self-managed super fund has exchanged on a property up on the Gold Coast, a little
Nice.
unit last week.
Yep.
So they've exchanged, but we're looking to settle in September. Are we going to get caught out?
No, it's based on the contract of sale when you signed it. So the fact that you've already signed it, and I think that's what exchange means on Gold Coast, that's a bit of a UK sort of terminology when you say, yep, we're about to exchange on a property. But because you signed the contract of sale already, but it settles in September, you're fine. So at the moment, it'd be good to understand, no, it's an SMSF, so it doesn't sort of correlate to the budget night or anything like that. So you are fine in the meantime. Even if for some reason settlement gets pushed out even further, you're okay. Again, it's based on the contract of sale date, which you've already confirmed, you've already signed off on, and that was probably pre-budget as well. So that's good. Yep, good
Yep.
question. Question here for Jeremy. Around the interest rates. I'm a pay-as-you-go earner in London, so on a normal wage, employed, looking to buy in Brisbane. Does the softer headline inflation mean my borrowing capacity improves? It's a good question.
It's a good question. No, for this expat in London, focusing more on what the current rates are, because that's going
Mhm.
to drive our assessment rate, which will drive how much we can borrow, and also the exchange rate. So, earning pounds, I'm assuming that has weakened a bit over the last few years. So
Yeah,
that
that's, yep.
will reduce your borrowing capacity.
Yep. Yep. So less purchasing power just because the currency impacts. So, but
Yep.
still go ahead, get your pre-approval sorted, and see what you can target. If you need some help, highly recommend buyers agents as well. There's some great ones on the east coast of Australia.
Yep.
Next question here. I'll inherit my father's Sydney rental. He bought in 2004. Should I be doing anything before mid 2027? So just to remember, this property is already an investment property. It is not a main residence. Um, so I think probably unpacking that one a little bit from a tax point of view, because your dad bought it in 2004, you will inherit their cost base. Just remember that it's not a taxing point when you inherit it. Um, But just remember, based on the updates, the taxable gains will now be split across those two different sort of legislative periods. Anything before that, you'll get the discount on. Anything after 1 July, that'll be that new method, the indexation method, and then the minimum tax. I think what you'll see, especially in the next probably year, um, we need to have a bit more of an understanding of market valuations, whether everyone has to go out and engage independent market valuers, or whether there's going to be some online tools that can be used which produce a report. If you're an estimator or a property valuer and you're in that game right now, I'd be looking into AI and ways that you can develop such a squeaky clean system for everyone to get clean, documented, verified market valuations, because that is going to be big business as of next year.
Yep. Valuers and accountants, they're going to be very busy over the next 12 months.
They are, absolutely. Tax compliance is going to be interesting after 1 July next year. Good question here. Question 4. My ex and I are splitting our Melbourne investment property under a BFA. I live in Dubai. What's my exposure? Thoughts, Jeremy?
Yeah, so they'll still get that rollover relief.
Yep.
From the original cost base, but then you just need to, so the original cost base will still apply. There won't be a CTT event when you kind of split that property out, however the arrangement dictates that. But then just have to be mindful that there'll be that date there of that 1 July 2027, and just have to be mindful as you're a non-resident, you still won't access that 50% discount. So if you were to dispose of it as a non-tax resident.
Yeah, that's right. Yep. So good question there, to be honest. That's going to be a tricky one. Really important to understand that that's only under a BFA. So that needs to already been established when you got married. A BFA is like a prenuptial agreement. We call it binding financial agreements in Australia. They are very expensive to do, just because usually the law firm has to have the insurance behind them to be able to do them, and they can be a costly exercise as well. So just keep that in mind whenever you get hit or get asked about BFAs and what they cost and all those sort of things. Really need to make sure the juice is worth the squeeze when entering into them. That's probably it from us today. I mean, a bit of a recap. There's a lot coming at us, fast and loose at the moment, but inflation's sticky. Limited recourse borrowing arrangements are changing in SMSFs. The CGT reset, and obviously the lifestyle event traps. There's plenty going on.
But we've got a couple more. We'll have a few more guests coming on in the coming weeks. So keep the questions coming through. And yeah, until the next episode, look forward to it, James.
Sounds good. Thanks for your time, Jeremy. And thanks for tuning in on another episode, guys. See you on the next one. Cheers, guys.
Thanks, guys.